All right, welcome everybody to Midas Investing Live. Happy Sunday afternoon to everybody out there, anybody out there. You all had a good week. I know I had a very busy week, but made it through. Got everything we needed to done for the most part. Though it definitely had its challenges. One part of this week that I definitely wanted to call attention to right off the bat is the fact that I made an appearance on another channel on Monday, that being Stone Cold Investors. I appeared on live stream here with Jesse of Stone Cold Investors. So I'd highly recommend you guys check that out if you haven't already. It's a nice little talk. We, as you can see kind of by the title, kind of primarily talked about AAP in terms of like a specific company, though we did cover other companies, the economy in general, interest rates and stuff like that. Also talked about PayPal pretty substantially. And me and him chit-chatted a decent bit behind the scenes. We hadn't necessarily had too many conversations prior to that discussion, but I don't know, maybe we'll have other conversations at some point in the future. So either way, wanted to make sure you guys go out there and watch that, get it more views. Maybe that'll help incentivize to bring us back on in the future, showing that our community comes out. But either way, so this week in the portfolio, didn't do too much. I actually did a relatively small, I basically did no buying all week up until Friday, and then kind of like realized that I had done basically no actions up through Friday. And then partially I have significantly slowed down a lot of purchases. I was definitely going a lot faster on my purchases a few months ago. And it's partially because I got my cash position sort of into a range where it's a little bit closer to where I want it to be. Though obviously you can see right here, it appears like I'm way over it, but that's because my leveraged liquidity position on VU is currently in its more default state rather than its bullish on state. So, there's a little bit of an ebb and flow, but the point is I could still go a little bit lower, getting in this point right here, maybe down to kind of like the 15%, so that when it moves back and forth between relatively high and medium levels of cash, should be more like between 10 and 15% rather than this kind of like between 15 and 20%, which is where we currently are. So we're still trying to get a little bit lower. We did buy a little bit more Generac this week. We did buy a little bit more InMode this week. And then on InMode, well, there's things to sort of talk about in regards to that company. I figure might as well make a comment about it because I had at least one person kind of message me asking my opinion on whether or not the unfortunate violence that's going on in Israel right now as a result of the attacks from the group Hamas, and then Israel's own counter offensives on that. So there's definitely major conflicts going on in Israel, which is not exactly anything new. It's definitely stuff that's constantly been going on. And if you are involved with companies in Israel, you definitely just have to be aware that they're a country that unfortunately has not the greatest of relations with their neighbors. So that sometimes spikes up a little bit, and that's currently the case. Now, in regards to InMode in particular, I wanted to at least say that I don't necessarily think that this is going to have a huge effect on the company's operations. That remains to be seen. Fool me if that's the case. What I would say about InMode in general is that they primarily do research and development and sales and marketing. Like that's pretty much what that company does. Is they design the products and then they market the products. And so it's not like they have a huge amount of those products being sold to the Israeli economy in particular. They do have some, but the point is America is actually the largest market that they are shifted towards. So I would say that I'm not hugely concerned on that front. There is the manufacturing aspect of it to be taken into account, but their operation, from my understanding, is mostly centered around Tel Aviv, which is much further north than where the violence is currently. So as long as the violence seems to contain itself over the next few days, though that totally remains to be seen. We'll see how that actually goes. Definitely be keeping an eye on it to see if it gets worse, but I have a feeling that a lot of the worst probably already has passed. Like I said, fool me if for making those comments if it decides to actually get worse. My feelings for anybody who happens to live in the area that might be suffering in any way as a result of the conflict. Definitely. Yeah, the comment there, I think just the drama will scare people. Yeah, I mean, that's basically what I'm expecting. I didn't actually comment on it when I had the article up right there, but it said that the shares on the Tel Aviv exchange are down about 7%. So obviously, you know, the scare is already starting to hit the equity markets. Yeah, it's really just a question of how substantial the actual damage is to their business, and I definitely don't really think it's super likely that it'll damage their business. So it might make InMode cheaper in the short run, but we still have that earnings season coming up, right? So we'll see how the market decides to maybe bounce it back, you know. Oh yeah, you're looking at the dashboard right now. Yeah, I was definitely going to bring that part up, which I was going to say it's possible that maybe, like I said, if we do get maybe some sort of I don't know, slowdown in some of their manufacturing operations, perhaps. Like that's one way I could possibly see it affecting them, is that there's going to be limits on lots of flights going out of the country, and then they do have their manufacturing partners in Israel, but I'm pretty sure their manufacturing partners are also very centered around Tel Aviv, which is relatively far from where the violence is currently. So the point is I don't necessarily think it will really affect those operations, but the point is there's some ways in which it could affect their short-term operations by it somewhat disrupting their manufacturing. And so under that kind of logic, I could possibly see short-term estimates coming down a little bit, which means maybe my valuation could maybe use an adjustment to the short-term assumptions. But yeah, Scott there is commenting how it looks on the valuation dashboard, which I'll flip over it briefly. But yeah, it's coming up very, very cheap in terms of the percentile of the distribution that it's at. Super, super cheap, which is not the only company that's way down there in that terms. We also have LPX that's in the single digit territory. But that's another one that, well, I was going to make comments on. That's in a kind of totally different direction. So let's see. So kind of one other thing I kind of wanted to comment on is the massive run up that we are getting in the bond yields. I mean, I commented on it a little bit when we were talking about inflation in the past week, but really, well, we're not going to talk about inflation right now. We're getting an inflation report this week, and I already have my estimate for what I think it's going to be. My estimate's relatively close to where the consensus estimates are this month, which is around 30 basis points, which should mean that the year-over-year number should come down slightly. Like around 10 to 15 basis points on the year-over-year number. It should come down approximately based off of that. But still putting it relatively, you know, the kind of like low to mid 3% in terms of the year-over-year number. But the point is the long-term rates, this is the 10-year yield, is still running up. Just look at this. This is a weekly chart, by the way. So look at this. This is weekly chart for 5 years. Definitely just running and running and running. And one thing I want to point out is that, like, when we had hit this peak point before around 425, a lot of people were so definitely adamant that that was the peak. We had been coming down quite a bit, and I mean, I had basically always believed that we had serious potential to go higher in terms of the long-term yields. But even when we were getting to some of these lower points, even I was definitely starting to kind of capitulate my opinion on that, and was more in the camp of, well, you know, it's very possible we have already peaked, but I can see why we would go higher. You know, I was kind of like leaving it in both camps sort of once we were at these lower levels, because it definitely felt like maybe we were going to start having a decline. Maybe J-Pow was going to lose the essentially the will to keep pushing through it. But with the fact that the Fed funds rate is still significantly up, and J-Pow still seems to be showing us that we're going to be higher for longer, at least until something breaks, as everybody's saying, we're getting the 10-year really start to drift higher. Which if you recall, when we were talking about the inversions, I was kind of telling before how in general there's two ways in which the inversion uninverts, which is to say that it's either the short end comes down or the long end comes up. And so if you have the and so if you have, here's the Fed funds rate put up against it. So you can see the 10 years really starting to actually push up towards the Fed funds rate, which means at some point or another, we might start to get an actual uninversion. Now this is the Fed funds rate, not the 2-year, but the 2-year and the Fed funds rate to usually track much closer to each other. Just to show, we used to have this huge diversion of it as it was going up. You can see the 10-year basically was trailing along with it, but then at the point where it had reached the previous peak, it showed that basically the market no longer believed this portion of the increase. They thought that this was kind of the point where we needed it to come back down, or this is sort of the point where they thought the economy was truly going to start breaking. But the point is because you can see, it's like it's not that the short rates are coming down, it's that the long rates are coming up, which in many ways is the worst option. Because if it's the short rates coming down, that means that you're probably going into an economic recession of some sort, and the Fed is trying to dump liquidity into the market. But that might set you up for a rebasing of the growth going forward. With the 10-year going up, what that typically is going to imply is that there is actual inflation expectations that are coming with that. If we come over to the tips rate, you can see right here, the tips rate's been going up pretty significantly alongside that. In fact, they pretty much mirror each other and have mirrored each other for about the last year and a half. Usually they have a little bit more of an inverse relationship with each other, because the tips rate is essentially an estimate of the growth expectations in the 10-year treasury, assuming you're using the 10-year tips, because this is 10-year treasury inflation index. So this has inflation stripped out of it. And bond yields in general are a combination of growth expectations and inflation expectations. So this gives you an idea of how much the growth is expected. But then you have to keep in mind that most of the people are pushing down the inflation expectations because of the belief that the Fed is going to drop the yields, and we're going to go when we go into a recession. Most people associate recessions with deflation because they kind of like to ignore the 70s, 80s period as some sort of like anomaly or something like that. But that's what I'm trying to point out here, is that I think it's very concerning that the long rate is going up, because if the long rate is going up and it's not the short rate coming down, I think that's the thing that generally is probably going to forecast more of a higher inflation in the future. The inflation expectations are starting to stick. The long rates were the ones that were basically not moving all that much before. Now, coming over to the Fed fund rates charts, the CME website, we still don't have super huge expectations in terms of the next meeting in about a month. We still only have about a quarter of the participants forecasting for a rate hike. Though, as I've explained before, it's usually that this chart is really kind of a combination of people voting somewhere over here and then some people voting somewhere way down here. So it ends up being just a weighted average of whatever the participants' actual votes are, what this curve looks like. But the point is people still don't seem to believe that we're getting any more rate hikes, at least in terms of the bond pricing. And then that's worrisome in and of itself, because if it's not priced into the bond market, it's not priced into the equity market. And if it's not priced in the equity market, we're likely going to have declines in the equity market. See, Aryan has showed up and he's here to try to give us the good advice. He's just going to say, don't worry about any of this nonsense. Just buy great companies and sit tight. Yeah, I mean, you're not wrong. As I said, I was buying this week. I was buying Generac and I was buying InMode. One more than the other might have some economic volatility with it. I don't know, maybe Generac, I feel like it, is a little bit more of the discretionary buy on one end of the things, while InMode is an aesthetic product. So on another end, it sort of is very discretionary, but it's also much more marketed towards the wealthy. So that's why I would say it's like they're kind of in different camps of like different kinds of consumers that might be experiencing economic pain at different times in terms of the companies I was buying this week. But yes, buying all the time, always buying. We don't let the economic clouds keep us from buying companies. We just still like to pay attention to the economic clouds nonetheless. Aryan says he's valued Microsoft and has fair value around $300. $300. I'm not so sure on that one. I don't know what is my number for them. I have a pretty low number, relatively speaking, for them, but it probably needs massive adjustments on it because I never built a full model for it. So I probably only put some like really low growth rates on there and probably very conservative margins. So you can probably ignore the number that I have right here. It's on my back page, not on my main page for a reason. But $300, maybe that's fair value. Could be. I am looking to do some changes to my one second, notification, my streaming software. Oh no, okay, never mind. Misread that first. This week I am on my fall break for my school, which in my particular case really only means like 1 day off of school, but nonetheless that makes a pretty big difference to how much free time I have relative to everything else. And I'm kind of made the decision this week to try to kind of like lighten the load a little bit for myself, rather than doing a new valuation for this week, because usually I have videos come out every 2 weeks. I'm finally going to do a video that I was planning on doing for some time, which is kind of a brief overview of 10K filings or annual filings, to kind of like give people a rundown of the different sections and like the different types of information that they can find that's useful for their valuations in those different sections. Something that I had suggested I might do at some point in the past, people have asked for in the past. It may not be a very long video, it might be relatively basic information for some people, but either way, I've been trying to think of some other more kind of like basic learning to invest type content that I can make. So that's one thing I think I'm going to do this week. Probably going to be trying to make that tomorrow. But the point is I think that will free up most of the rest of the week for me, because it's a little bit less intensive of preparation for making the video. I haven't, I don't have to do a bunch of research for that. I can kind of just talk about what I already know. In that case, I don't have to research a company. But then that might leave basically the full next 2 weeks plus the rest of this week, so close to 3 weeks to work on the next valuation I want to do. Because frankly, I've been kind of slow in my output of DCFs for the last month or two. I tend to kind of go in little swings where I do them in bursts and then slow down for a little bit. And kind of getting to my general methodology of how things work, as I was kind of just talking about the Microsoft valuation here on the back page, I usually do a basic valuation first, putting in some just basic numbers without really thinking too hard about the industry and the long-term perspective of it. I'm just kind of throwing in some numbers based off of what the historics look like, kind of. And then I throw it on this back page so I can kind of keep track of it. Maybe this includes some alternative investment styles as well, where I'm thinking about things from a different perspective. And then at some point or another, maybe I decide to put together a full revenue model, and then I'll put it onto this front page here. By full model, I mean that I literally try to break it down by the units that they're selling in terms of products and services, break down the type of market it operates in, maybe compare it to some of its competitors in a more generalized sense, and also try to also do more thorough, comprehensive work on their operating costs and their capital costs as well, depending on what information the company provides me. But the point is I don't make videos on any valuation unless it's on this front page. The back page is kind of like the work in progress page, so to speak, and then the front page is the like actual finished works. But I am, like to pay attention to things and don't necessarily want to always put the same amount of effort into everything before I start it. Speaking of which, I'm seeing, actually, now that I'm staring right here, I still have ASML on this back page, even though I already added it to the front page. So I should probably delete that real quick. But anyway, I partially bring the process up, even though I know I've covered it before on here, is because I also have other steps that I take before sometimes things make it onto here that I don't always do all the time. One thing in particular that I haven't done a whole lot of for several months now, I think it was closer to the start of the year, the last time I did a larger piece of this type of work, which is really going through and screening through some stocks. I feel like for the last several months, it's been a lot more of a focus on like just brand names that people already know about, companies that have been dropping very recently, suggestions that you guys have thrown my way and stuff like that, rather than me kind of doing some down and dirty work on Ticker, which is where I usually do a lot of my screening work, partially because I have one of the premium subscriptions for this website, so that's just where I use it. Not to say that that's the best website for that type of work, but the point is that's the one I use. But the point is this week I decided to kind of get in there and start doing a little bit more screening, see what we could come up with in terms of some names in some industries to look at. So I wanted to kind of go through that and the process so you guys can get an idea of how you can do this. You can kind of pay attention to like how and what I do here. If you don't have the premium service that Ticker provides, they still provide some screening availability for free, just maybe not to the same details I do. Like they offer you more screens, I think, as well, more pages of screens that you can keep as well, because you can have multiple pages saved. But anyway, so the one that I did here today, firstly, I focused primarily on just US, British, and Canadian companies. I just wanted to limit it to the jurisdictions that I have the most familiarity with the legal systems of. I obviously have shown that I'm more than willing to invest in other companies, but for this particular screen, I wanted to keep it a little bit more simple. I wanted to focus in on industries where I can get more accurate data sets based off of these economies. Then I also kind of made sure that it was focused even more specifically on the exchanges of those countries, in particular the NYSE, the NASDAQ, the ARCA, the TSX, and the LSE. I could have thrown a couple other of the more minor ones in there. But anyway, that's just kind of trying to screen out some of the smaller stocks and more foreign stocks that are a little bit more far away. I also kept it my market cap over 100 million, total common equity, which is book value, over 0. I didn't want any negative book value here. I wanted total liabilities as a percentage of assets to be less than 75%. I actually felt like that was maybe too limiting once I got too deep into the process. But by that point, I had already done a bunch of work. So honestly, I felt like maybe I could have pushed that one up to 100. The reason why I say that is because I do a lot of this screening separated by industry. And so if you're going to separate by industry, you can probably let that value kind of just be dependent on the industry. Current ratio, I wanted to be greater than 1.5. That's another thing that is pretty questionable whether or not it was necessary, because depending on the industry, it changes how much that matters. And that's honestly a pretty decent current ratio. One might have been more appropriate, I don't know. Forward EV to EBIT, I didn't want anything more expensive than forward 20 EV to EBIT, which PE ratios are usually a little bit higher than the EV to EBIT ratio. So just for comparison's sake, you could say that that's maybe like a 25 PE ratio or something. Approximately maybe 22, 23, 25, something in that range. But then I also chose to display forward CAGRs for the estimates of revenue and EBIT. Just display. We didn't limit any companies based off of what they had here. We just wanted to know what the CAGRs were for the analyst estimates of revenue and operating income for the next forward 2 years, and then display the industry. And then we also got rid of any EV to EBIT that was less than 0, because a multiple less than 0 doesn't actually mean anything. So that's the screen we ran on, just so you could literally know what I put in there. And this might also give you an idea of how you can put together your screens. Some of these, as I showed here, were about trying to limit specific companies, but some of them were just trying to make sure we didn't have companies that aren't going to be useful to look at, like making sure we had a positive book value company. That's because I want to have the returns on invested capital and the returns on assets and return on equity numbers actually be useful. And the same thing with the EV to EBIT less than 0. It's like there's no point in having that, because it's literally meaningless if multiples are 0. Jack is throwing the ticker SOHU in there. Maybe we'll take a look at that later, or maybe I'll take a look at it offline, but maybe in a little bit. I'm trying to remember if that one maybe pops up somewhere in here. But anyway, point is this screen popped out about, well, exactly 974 companies right here. And then, as I had kind of said, I took all of those over to a spreadsheet where I could work with it and kind of play with it and screen it down a little bit further. So this is like the total list as it is right here, just keeping all those metrics right here. And then as I said, we have the kind of the industry groupings right here. The thing about Ticker, and probably most data services, or a lot of data services, have these issues, but Ticker definitely has this issue, is that some companies will be listed as a kind of strange industry. Like you'll find sometimes something listed as one industry and you'll be like, that doesn't belong there. So like the way that they categorize things in industries can be a little bit weird sometimes. And also the tickers themselves that they list relative to the company name, sometimes you'll be like, that's not the ticker. So pay more attention to the company name, I would say, than the ticker. But yeah, because like sometimes they get them wrong, I've noticed, or it's like for a different exchange, or it's like for an alternative share. And then the industry, they also sometimes categorize wrong, but we're gonna deal with that issue to a certain extent. So what I chose to do was essentially screen down all of these categories by basically by the different industry groupings. But I chose so many wrecked vehicles. Yeah, but you gotta keep in mind like what's right here at the top though in terms of industry. It is listed by alphabetical order. You'll see right here. So that is just kind of what happens to be at the top. So anyway, what I chose to do is I chose to basically try to figure out what the averages, or actually not the averages, the medians are for each of these metrics by the industry groupings. So because like, you know, these metrics are useful for trying to figure out which companies are good, but as I was kind of just implying there, often metrics are very industry dependent. So I was like, okay, let's take a look at each of these groupings separately. But I did also want to make sure I only had groupings that were of a significant size, partially for the reason that I was just saying before, that you often do have tickers that are in the wrong industry groupings. So I chose to only pay attention to industries that basically had at least 10 within its grouping right here. And then I made that list right here. This is the list of the groupings that we ended up keeping. And then, like I said, I chose to keep the median metric for each of these categories for each of them. So you can see the median market cap for each of these industry groupings as it was left, the median liabilities as a percentage of assets, median current ratio, median forward EV to EBIT, and then forward the forward growth metrics as well. And then what I chose to do is I chose to take the median across all the industries, so you can see right here. So a more typical across all companies liabilities ratio from this sample would be about 50%. The companies themselves are about 2.5 billion in terms of market cap, current ratio of about 2.3, 2.4, forward EV to EBIT about 10 to 11, and then forward revenue growth about 3.5%, and then forward operating income growth about 7%. Something like that would be typical across the entire economy based off of this sample size. Of course, keep in mind how much sampling filtering we did here and how much survivorship bias that's going to imply based off of the metrics we did there. There's always survivorship bias once you start filtering out a bunch of stuff and then taking average and medians from those metrics. So keep that in mind. I know this. I understand how statistics work. You can still work with that data, but you have to understand that these numbers is not like an actual average across all the economy. It's an average across pretty decent companies within the economy. But anyway, going further with that, the point is then what I chose to do is then pay attention to essentially which of these industries was better than the overall median on each of these categories. And then that's the ones that are highlighted green right here. And then we listed how many greens each of them had. And then we sorted them based off of that. So here at the top, we essentially have our arguably the most appealing industries to go look into which companies are within those groupings based off of the fact that they are relatively small companies. They have relatively low liabilities relative to their assets. They have decent amount of current liquidity. They're relatively cheap, and they also have decent forward growth prospects, at least according to the analyst estimates. So here's essentially the work we did. I separated them out down here further by the different groupings. So we have biotech, we've got communications equipment, consumer finance, energy equipment and services, interactive media and services, metals and mining, which metals and mining is a very, very large sample grouping right here. You'll notice very, very large sample. Software, diversified consumer services, healthcare equipment and services, oil, gas, and consumable fuels, and that's all of them. Now, you may notice that some of those are more closely related than others. Like in terms of, we have a few there that kind of all go together in terms of energy, right? And then you can kind of throw metals and mining in with the energy and say that those are all very like natural resource and a kind of a heavy machinery focused, right? So you can kind of see how those ones would be pretty closely related. We do have some healthcare stuff, but they're kind of somewhat different in terms of the healthcare. Biotech versus healthcare equipment is somewhat different. We do have some kind of consumer services and finance, and then some of the software might kind of flow into that category as well. But software might also have some significant overlap with the interactive media, stuff like that. So depending on how you kind of like think about these groupings, like I said, there's also going to be some weird one-off companies within some of these that are going to totally not be categorized correctly, because sometimes Ticker just has something categorized weirdly. So that's kind of the point of looking at medians partially, is that it massively helps us figure out what some stuff is. Now, looking at some of the comments you had there, because I kind of was ignoring them there. Jack said, well, the automobile stocks there are all wrecked vehicle makers. Yeah, like I said, it's like, yeah, that top grouping on that front page, it was sorted by alphabetically by industry. So that's partially why we ended up with a bunch of that stuff kind of right here at the top front section. But those also do get categorized in some extra areas as well. And then you also said biotech is oversold. Makes sense. Yeah, I mean, that's the thing, is like, it definitely seems like biotech has a lot of opportunities in it, and it seemed that way for quite some time. I know you've definitely mentioned a few names over like the last year and a half towards me, and I've always just kind of been like, I don't know. And that's still kind of how I just feel about biotech. It's like, it's one of these things where it's like, I know there's probably amazing opportunities there, both in terms of just how cheap the industry seems to be relative to its fundamentals, also just relative to the kind of industry macro perspective that I have over what's happening with the demographics and stuff. There's a lot of reasons to believe like why biotech would just continue to be great for the next decade. But doesn't mean I know specifically which drugs are good ones, since like, I don't know, I just don't understand medicine that well. So it's definitely harder for me to feel comfortable with that industry, but seems like there's opportunities there for sure. To looking further at Aryan's comment, if you look at Disney's earnings before interest after tax before 2020, it was a little above its net income, but now it's like 3 times the net income. I always use earnings before interest after tax for my DCFs. What would you suggest I do with Disney? Jack says, simple, sell Disney. Seems that the largest players are monopolizing the approval process. Yeah, I mean, Disney is super cheap right now. It's so cheap, and yet it still seems like not cheap enough at the same time. I don't know. I haven't looked super closely at Disney their stuff for most of the year. I've kind of just been watching from sidelines, but my numbers for Disney is definitely not super great. I think they are much closer to fair value now. What do I have them at? Oops. Right, cool. What do I have them at right now? Yeah, so I have them at like 65 right now, but that probably needs some upgrading. I was probably being too pessimistic there, so I might push it. Like if I was to upgrade my numbers assumptions there, it might push to 70, 75 or something like that. But at the same time, I believe I said it a week or two ago that they're probably going to, well, not probably, they will have their annual report come out in about a year, or not a year. Man, can't speak correctly, in about a month. And so when their annual report comes out, I'll probably just dive through and then redo my DCF at that point. So it's possible that this number is very conservative because I was being very pessimistic on them like 9 months ago, something like that. Did someone say Disney? As Jack says, kids aren't even growing up on Disney anymore. Why pay a premium? Yeah, and see, that's part of the thing. It's like Disney has really shaken up their business model, and not for the better. It's like they did kind of what they had to do in terms of like making a lot of the acquisitions and trying to get Disney Plus out there, but they overpaid on some of the acquisitions, and then other ones they should probably just not gotten because of the pricing that they were getting and stuff like that. So it's like they went a little too ham in that regard, and then I don't think that they thought super seriously about who they were attaching to some of those properties, and so they've kind of made their apple cart get a little tossed over in terms of their fan bases, and so it doesn't quite have the same like super solid, for sure understood family brand as you're kind of bringing up there. It's kind of like several different camps of types of people that Disney's trying to appeal to all at the same time, and I think they're having difficulty appealing to all those different camps simultaneously. And the obvious thing that people talk about with them and like companies like Paramount and versus people like Netflix is that they have to sort of cannibalize their previous business while doing this process, and that's a very expensive way to deal with the very expensive industry that they're already in. So yeah, I don't know, I'm not super bullish on Disney, but I've been super bearish on them for so long that I'm well aware that I'm possibly being too bearish on them. I was a buyer of them at higher prices than they are now in the past, but I was probably making overestimates at that point in time. So anyway, let's actually go through these industry groupings here and take a look at some of the specific companies that are there within it. As I was kind of saying here with the groupings above, I had shaded them by how many greens they had, which was essentially how many of them by category were better than the median. Well, I did that same process on the individual industry level as well, so that we could get an idea of which companies specifically within the industry groupings that are supposedly the best industries that we should be looking at. Well, what are the best companies to look at within those industries? So let's actually take a look at that. So in biotech right here, I highlighted specifically what I have highlighted in the purple is the ones that are 5 or 6. I kind of did the same thing over here with anything that was 4, 5, or 6, just so you're maybe know what's listed as purple. But obviously, they are still listed in order of how many greens they are. So if you want to look further down the list, that's your prerogative. I'm just gonna at least mention out loud the companies here. And I haven't really done a whole lot of specific looking at any of these companies like individually, but the point is that's the work for this week. That's as I was kind of saying, what led me into talking about this process was me saying how I was not going to be putting out a DCF video this week. I was going to be putting out more of a learning to invest video this week, and then we're going to have more closer to 3 weeks to really be diving into this and trying to figure out the next DCFs I want to do, because I don't know, I wanted to look at some companies I haven't looked at before, is I guess the feeling I was getting. So anyway, Stoke Therapeutics. Stoke Therapeutics, we got Lyell Immunopharma, we've got Nanta Pharmaceuticals. I have never heard of either or any of those three. I don't know if anybody in the chat, whether live or on the replay, has heard of those. If anybody hears about any of these names or has anything of use to say about any of them listed here, I mean, feel free to tell me what you think, what you know, or whatever about any of these companies, because yeah, that's, like I said, we're looking for what we think is maybe opportunities, and we've screened down here based off of these metrics, these pricing metrics and these fundamental metrics. But if we could get a little bit more of an abstract understanding of the company, or something to grasp around their products that makes it worthwhile for them, that would also be useful as well. As far as the other ones, I mean, I don't really recognize most of them either, except for Vertex, Regeneron, BioNTech. So some of the ones in here at the bottom are a little bit more recognizable. Inovio. Oh no, I've heard of Inovia, not Inovio. Inovio was a COVID meme stock. Okay, yeah, I'm not sure. Maybe I had heard the name before. But yeah, some of these ones near the bottom are names I've heard of, and I've owned Biogen in the past. But yeah. So, but either way, beyond Biogen, I can't say that I actually know what any of these businesses do. So that's the thing. It's like, out of this whole list, the ones that I actually know what medicines they have and like what the medicines are about, that would be Biogen. That would be the only one that would apply for. And you know, it's also the one that's a 0 on this list. It's worth noting. So, but anyway, coming down further, we look at communications equipment. We got Gillette Satellite Networks. Also never heard of them, but they seem to be relatively interesting relative to this grouping. A little bit of a smaller grouping here. Other ones I've heard of, Viasat. This one's definitely been suggested to me a few times before. I've never really looked super closely into them. Got some pretty outstanding growth potential on those ones. I mean, I didn't even really notice into some of the specifics on the biotech ones there, but in particular, you know, if you see something where it's like over 100% in one of these categories, that's definitely something maybe worth noting. Sethin, okay, yeah, that was where I saw it most recently. I thought I had seen it somewhere most recently. Sounds like Seth Klarman was in it somewhat recently. Yeah, well, he's definitely, I've seen him, you know, I've watched his reports for a while, and he definitely seems to skew pretty heavily towards a lot of communications companies. I've definitely seen, it seems like he has a pretty large favoritism towards that category at different points. But down bigger, so he downsized it a bit most recently. Interesting. But I mean, not exactly super high in terms of greens, only 3, and like I said, so it's not exactly above. You know, because like, gotta keep in mind here, it's like there's 6 categories here, so 6 is the number, 3 is average. So if you really want like 4 and up, like I said, I have purple highlighted on 5 and up, really, because that shows like just how above median they really are, not above average, above median. Oh no, he's down on his position. Okay, gotcha. Well, he does that too. Jack, Viasat makes me sad because the revenue growth is there, but they've never had free cash flow. Yeah, well, I mean, I don't know. Maybe another 50 to 60% growth in sales over the next 2 years. Maybe that'll do it. I don't know. Maybe maybe they just need to scale past it. I don't know. Maybe I'll have to take a look. I'll have to take a look maybe at some point. Scrolling down further, we come to consumer finance. Now, this is definitely one of the ones where some of the things here are a little bit of a weird listing. Like I said, it's like some of these categories that they have here on Ticker is a little bit random and haphazard. So like I said, if you see weird things in the list here, it's like, you know, like I said, we're taking the industry sort of for granted, but we're also taking it with a huge grain of salt. I do note here, EasyPW, this is one that has been suggested by a viewer of the channel multiple times before, and I had kind of like noted it as one that seemed kind of interesting in terms of how cheap it is relative to what it seems to have going on for it. But I haven't actually taken a super close look at it. But maybe at some point I'll take a closer look at that one. You guys still talking about VSAT? 12% of his portfolio, it sounds like. That's pretty significant. Very recent, very profitable net income, says Jack. Still no cash flow. VSAT under book value. Do you love a valuation video on VSAT you're talking about? Assume you weren't necessarily listening to what I was just talking about. Maybe. I mean, like I said, maybe I'll take a look at that one this week, or at least the filing, and maybe I'll do a quickie on that one. But then other ones listed here, we got Finvolution Group, Propel Holdings. These ones are ranking pretty high. I don't really think I know too much about these ones unless it's like one of the products I've heard of Propel that wouldn't really be supposed to be here. Propel Finance, I don't know. I'm not too sure on those ones. $38 average from Seth. What is it right now, actually? Wow. Wow, really? Really? 38? That's pretty rough. Wow. Poor Seth. But all right, so moving on though, we got energy equipment and services. Now, obviously, I kind of commented on the fact that we had some of the natural resource and particularly energy resource focused categories that it popped up here. You definitely want to be very careful with those. Obviously, take them with a super grain of salt. Pay attention to what's been going on in those markets lately. Obviously, prices are a little bit elevated in the last weeks. This is a weekly chart. We go into a yearly chart or a daily chart for the last year. You can see, I mean, we're coming back down in the last couple of weeks, but still relatively higher than we were several months ago. Still kind of in the same range we've been for the last few years. But the point is oil prices aren't exactly at a super low level. That's kind of what I'm trying to point at. So be a little bit careful in the way you think about some of these metrics because of the way very cyclical industries can be priced and stuff. And then also be very, very perhaps skeptical of some of the analyst estimates here, unless they have like very specific fundamental like business transaction based reasons to believe like why this specific company is going to have their sales grow 64% next year or something like that. Like maybe they acquired something and so it's obvious why their sales are going to grow. But be very, very careful on taking these growth estimates for granted if it's based off of just commodity price changes. That's kind of what I'm trying to imply here. It's like be very, very careful in how you think about these things. But anyway, enough caveating of this industry. We have here Hunting PLC. So presumably that's one of the British ones. Tidewater and Select Water Solutions, none of which particularly ring a bell for me. Like I said, these are the kind of energy equipment companies, so they're a little bit less known than the actual direct names. Some of the names on this list stand out to me, but they're some of the ones that are closer down towards the bottom of the list, similarly to what I was saying with Biogen. But could be worth paying attention to some of these. The equipment side of the business in some ways is much more cyclical than the actual commodity itself because of the fact that it's part of like the capex cycle. But at the same time, that means that the prices of their products specifically aren't going to necessarily be about the commodity. So that part is, it's just going to be their orders are going to be more related to when the commodity is doing well. So got to keep that part in mind. But the point is that means that this part of the energy industry could be maybe more appealing than others, depending on how you're thinking about that commodity industry itself. Coming down further, we also got interactive media and services. This is another one of the categories that has some things listed here kind of weirdly and other ones kind of more appropriately. So it's a little bit strange on that. But then the ones that it seems to show here towards the top is Yalla Group Limited and Zihu, neither of which are familiar names to me. Kind of interesting. I'm seeing here that they're expecting huge sales growth on this one, but a huge EBIT decline on that one. That's kind of interesting. Both of those are also under $1 billion in terms of the market cap, relatively cheap. Obviously, we have some of the larger companies making this list, Google and Meta, obviously. But kind of maybe even interesting to think about the two of them compared to each other just on this list in and of itself. But yeah, I'm maybe less interested in some of the companies on the list. I still have Meta in my portfolio, obviously, so still have exposure to that. Coming down even further, then we have the metals and mining. Now this, like I said before, this particular sample is just really, really large. There's a lot of really, really tiny names when it comes to the mining space. And so that's definitely one of the reasons you see that. And also like I said, we're focused in particular on the US, Canada, and the UK. And Canada, as well as the UK, does have a pretty significant amount of natural resource balance overall. So that definitely has an effect there. But the companies that end up filtering towards the top, and I will say that within this particular industry, that's going to be a larger spread because obviously a different type of material is different from one other material. So iron mining companies and copper mining companies and gold mining companies might all be thrown together in this list. and that might really skew some of the perspectives on things. But again, we're using medians partially trying to help with that, but even so, that only helps with so much of the outlier issue that doesn't necessarily deal with out of sample issues. But nonetheless, we have a larger amount of companies that make a higher rating as a result of that, because the sample itself is just larger. But the point is that means you can also discard ones that are of industries you don't care about. Interesting enough to see Barrick Gold up on this list near the top, though, because that is the gold mining company that I still have exposure to in my portfolio. But then a few other ones that are definitely more gold focused, and then we have silver as well, and then we do have some iron in here, and then some other ones that are not as I'm not as familiar with. I don't know what SSR does and Karora Resources does, but yeah. So either way, like I said, not as appealing of an industry for some people, but I like to pay attention to natural resources. Though I kind of already have most of the exposure to natural resources I'm looking for, and just kind of looking for buying opportunities within those. In terms of metal, it's somewhat more focused on lumber and stuff. So coming out further, we have the software category. This is another one where it's a little bit kind of maybe strange, the companies that are being compared to each other, depending on like what parts of the software industry they're in. But then Opera and Tuya end up being the ones that seem the most appealing by how many overperforming categories that they appear in. Another one for Tuya where it's has pretty high sales growth expectations, but then operating income decline expectations simultaneously. So that's kind of interesting, but don't really know too much about most of these companies either. So that's another category where I would have to do a little bit more research, I think. Then diversified consumer services, another one with maybe some weird groupings, and also companies that I'm less familiar with. Chegg being one that I am familiar with. Pearson, familiar with that one too. Stride, familiar with that one. And then yeah, New Oriental Education, that one has been on the radar. So yeah, these more education focused ones here I'm pretty aware of, but basically all the other ones I'm not as aware of. Or Graham Holdings, I believe someone brought that one up to me somewhat recently. The name sounds familiar, but I can't remember what type of services they provide specifically. But then, and even so, it only says that Vasta platform up here is the only one that has 5 or higher in terms of the categories that it's outperforming in. So I mean, that's the ones that it says that are most appealing. I don't know anything about that particular one. Then we also have healthcare equipment in supplies. This is a category I am in general more interested in. And then wow, when you look at that, InMode, 6 out of 6 on this category right here, which of course people might be like, oh wait, isn't that an Israeli company? It is an Israeli company, but it's listed on American exchanges, and that was one of the criteria that it listed for here. So that's just one interesting way, partially just because of the way Ticker had categorized it. If I had used a different website, it's possible that one would have been screened out, but whatever. Interesting to see how it lists there. And then it's literally the only one that makes 6 greens out of 6 for this particular category, so that's pretty interesting. But then we do have a few others that do get 5 at least, though. Inogen, as well as Merit Medical. I believe I've heard this ticker throw my way, but I don't remember that name. Maybe that's one of the ones with the weird ticker signed to it. And then Zynex. So I don't really know too much about these ones, but as I said, this is an industry that I am a little bit more interested in, partially just because it is, like I said, more healthcare focused, and I do believe in kind of the more fundamental macro case for healthcare for the next decade. And it's not medicine focused. Equipment, products, and technology services and stuff like that, I feel a little bit more comfortable trying to learn what that company does. So it's like, point is these would be companies that I would maybe feel a little more comfortable trying to blindly go in and learn more about what they do. I was more than willing to do that with InMode, for example. So that maybe I'll take a little closer look at those ones. I didn't really say too much about the last ones in terms of like how much interest I had in looking into them. Software is I'm less interested in than when it comes to actual equipment type technology and stuff, but maybe I'll look into a couple of these briefly. Maybe look into Vasta, but if it's like a more of a finance consumer product, I'm not necessarily super interested in it. And then, like I said, I kind of already have my exposure when it metals and minings. So anyway, going past the healthcare equipment and services, Zoom video, yeah, that one, yeah, definitely lots of things you could categorize in different ways. Oh, the places we've been. Yeah. And so yeah, this is the last one, right? Yeah, last category, oil, gas, and consumable fuels. This kind of somewhat goes with the energy equipment services, but this is going to be more focused on the actual commodities. And then this includes not just oil, but it's also going to include lots of natural gas, coal, even some lumber companies can be thrown into this category depending on how it goes together. And then it's also somewhat of a larger category as well. So we do have a larger amount of companies that are going to end up higher than the median as a result of that. Specifically, we have TK Tankers, we've got DHT Holdings, American Resources, Alliance Resources. American Resources and Alliance Resources I've heard kind of mentioned my way a couple times before already. Kimball Royalty Partners, PetroTal, I've seen that one come up on some lists a little bit, and then Viper Energy as well. So I mean, it's possible that those could be worth looking into, but those all have the same caveats that I was kind of going on about the energy industry before with. Mr. Beast, hi, how's it going, man? But yeah, so definitely have to pay attention to that and the commodity prices as I was just talking about. But it's possible that some of those could be more appealing. And then also in terms of commodity prices, I was primarily bringing up the oil prices, but other commodities are going in different directions too. So depending on which one some of these fall into, that can make some of these more appealing. So anyway, that's a pretty broad overview. We kind of got into the nitty gritty there, talking about individuals there. It might have glazed some people over a little bit, but as I was kind of saying, let's go scroll up back to the top and kind of, somewhat summarize it from the top a little bit. Like I said, it's like these are all the industries that I've had at least 10 companies within the sample grouping after I'd done all the screening I'd done from Ticker. So relatively good companies are the ones that have the highest amount of over the median level of the kind of overall metrics, which gets them the green label here. And these purple ones are the ones that I labeled as 4 or more greens. So these industries are potentially very, very interesting industries to look at, both in terms of the analyst estimates seem to be pretty good. They seem to have relatively cheap multiples. They seem to have pretty good balance sheets, and they seem to be relatively small companies. And then within each of those industries, we found at least a couple that are maybe interesting. Some of these industries we kind of saw 0 of them as particularly interesting. So I don't know. I think I have maybe 5 to 10 companies that are particularly of interesting to me from this list that I might look at. But you guys, like I said, I scrolled past all these. Take whatever interest you want, and maybe pausing at certain points in the stream, and maybe look at some of them yourself. I did also kind of give you somewhat of instructions on how to run the screen yourself, so you could make adjustments from the instructions I gave however you want. Aryan asks, do you think I should focus on GPA in college? Kind of depends on what you mean by that. I mean, you have to focus on GPA in college because the GPA matters, but it shouldn't really be your primary focus. No, the GPA is just a function of trying to figure out how well you learned, right? It's a proxy. It's not the actual thing. I do think lots of college students get very, very, you could say like college minded. Like they get in this kind of attitude when they're in college where it's like, okay, I'm just trying to play the game of college and I'm just trying to min max the college experience. But right, like the point of college is to prepare you for your career after college. So I think you should do things in college that are going to prepare you for your career after college. And in a sense, the GPA doesn't really matter for that. But it does matter in the sense that they're going to look at your GPA when they're trying to hire you for internships and jobs and stuff like that, especially internships and stuff. So you do want your GPA to be at a certain level. Like I think if you feel like because the thing is like different students are in kind of 2 camps. Like there's some students where there's some students where like A's are the default, right? Like A's are the default, and they might get some B's, maybe even a C here or there, but like A's are the default in their mind. It's like they're going for the A's. And then there's other students that are just like, hey, a C will give me the grade I need to pass. There's different students are kind of paying different attentions to the levels of that. And, I'm not going to pretend like different people are born with different gifts as well. So it's like somewhat of that isn't your choice. But the point is I don't know what kind of student you are in particular. If you're the type of student that has difficulty with the educational environments sometimes, then maybe you need to pay more attention to your GPA to make sure that it's at the appropriate level, because you're going to really, really want to make sure your GPA is at least 3.0. There's going to be a lot of companies that are just going to not even really take you seriously at looking at your application if you don't have at least 3.0 GPA. But to be honest, you probably want to have at least 3.5 GPA. You probably want to be shooting for one of those the merited titles, the 3.5 and 3.75 and above and stuff like that. So it's like, to be honest, you want to be shooting for a higher GPA, but you might be there's plenty of students that have no problem hitting the 3.5 GPA. That's kind of my point with the other comments. Is like, if you're kind of pretty comfortable getting all A's and B's, and it's like you pretty much always just get all A's and B's, and it's mostly A's too, then you probably don't need to think about your GPA that much. You probably shouldn't waste too much time thinking about it more than you need to. If you're already getting a pretty good GPA, you should focus on other stuff. You should focus on getting some like activities and stuff, clubs, organizations, trying to get some sort of recognition, some sort of way like that. Because there's other stuff, and then there's your own personal education, as you kind of just mentioned right there. You're like, if I show my DCF models and show that I'm competent in finance, should GPA matter? And I would say yes, it still matters, because that doesn't mean that they're going to look at those things in the first place if they never even looked at your application because they filtered it out by 3.5 GPA. So I have these screens right here. If you don't think companies aren't doing that to your resume too, then you're kidding yourself, because like JP Morgan is going to get thousands of applications, so they're just going to take a huge chunk of them and throw them right in the trash based off of some basic criteria. And GPA is definitely one of those criteria. So that's what I'm saying, is like, you want to make sure you're at least at a certain bar. The bar might be 3.0 for you. It might be 3.5 for you. It might be 3.7, 3.8 for you. I don't know. It depends on how crazy you're thinking about it, and also your ambitions as well. It depends on where you're trying to go. But you for sure need to be getting more than 3.0 GPA, and probably want higher than 3.5. If I would say if you're higher than 3.5, you should probably focus on other things. Like, you want to do other stuff. Try to do organizations, try to get in clubs, try to maybe do some work on the side, and stuff like that. Yeah, like he says right there, GPA doesn't matter, degree does though. Yeah, so this thing is, you want to make sure you're going to complete your degree in the first place, and you want to be focusing on what you're doing after the degree more than that. I mean, I'm not saying that they won't care about your DCF models, by the way. I'm saying you should. I definitely have my channel listed on my resume, but I don't know how many people actually go and look at it. Like, they're probably, like I said, it depends on whether or not they looked at my resume in the first place, and it can be tricky enough to get them to look at your resume first. Gotta jump through lots of hoops to get there. I'm speaking this as somebody who is pretty close to finishing his degree, but hasn't gotten a job yet either. So take that with a grain of salt. You should only take my advice so much based off of the successes that I've had. All finance clubs are trash at Boston College. They might be, but you want to be a member and you want to show that you've showed up to a couple events. Like I said, it's like, it might be more about showing your ability to be committed to things. Like, there's multiple ways in which that stuff kind of shows what the people were wanting on those applications. It's not like you're going to go to the finance club and then you're going to learn a whole bunch of super special stuff from it necessarily. They might have some meetings with like some employers, maybe. Like, there's sometimes some cool events that the clubs throw that are worthwhile, but like the club meetings themselves, it's not like you're necessarily going to get a whole lot from those. It's social, where you're going to get networking. You should be trying to meet other students that are in your field and stuff like that. So that's what I'd say is like the value of that stuff, not necessarily the actual, like, what the event isn't necessarily always the most valuable thing. More about like who's there and stuff. So anyway, we can take a look at some specific tickers if people want to. We're getting close to the hour, so we might only have maybe up to another half an hour or something, depending on how long we go. I know Jack had thrown that one ticker. Oh, there he is, throwing it back up again. Spelled certs, not clubs. And spelled certs, not clubs. Okay. So what's this? Provides online media, video, and game products and services on PCs and mobile devices in China. The company offers online news, information, and content services through the mobile phone application Sohu News app, mobile portal sohu.com, Sohu for PC, online video content services through mobile phone application Sohu Video app, as well as iFox video application for PC. Also operates Focus CN, which operates online real estate information services, and 17173, which provides news, electronic forums, online videos, online game information. Also distributes games. In addition, offers online games. Okay, so just kind of like a lot of general online interactive media stuff for China. See what the estimates right off the bat are. We've got next year about 1% growth, and then maybe accelerating up to 8.9%. Had a little bit of kind of a whipsawing in terms of that overall, but declines. What happened when? Do you know what happened, Jack, in 2020? Did they like divest something, or is this like actual drop off from some particular game or service maybe that was popular that became less popular? I don't know. You tell me. EBIT pretty ugly for the next few years. Actually, before we go to the valuation, let's go over to the financials. Not earning returns on assets. So we saw that the EBIT numbers was going to be pretty garbage. Well, although with it being services, gross profit margin may not be super informative. So we had a couple positive EBIT years, a couple more here. See what type of costs are actually hitting them here. Got lots of R&D expense, so if I did R&D capitalization on them, they might actually have positive EBIT. That means, in fact, I would say they probably would have positive EBIT more often than not if we capitalized on them, maybe at like for 3 years. Hard to tell because it depends on the growth rate of the capitalization. And see, we had R&D accelerating a little bit for these few years, and then it also dropped off at the same time that we had the sales drop off. So still not super sure on what's up with that, but then it looks like it's been sort of more of a stable movement since then. And show that like this is what you want to see, and this itself is also sort of what you want to see, but you don't want to see this break in between here. So it's possible that maybe we still have negative EBIT for a few of these years after R&D capitalization because of this weird break off here. But still, the R&D trend is what decides that. Nothing crazy happening with share count. Is this why you're bringing them up to me primarily? Because of how much cash and securities they have relative to their book value? Is that what the attraction was? I kind of wonder. I don't know. I was kind of hoping you were gonna say something about the 2020 numbers. But do you know what happened in 2020? What happened with that? I mean, it's not uncommon, obviously, to see this type of stuff in China in general. It is somewhat just kind of like how they like to operate stuff. But the point is, like, I haven't really looked at the valuation stuff yet, but based off of seeing their lack of profitability in many years, obviously that means that they have no good metrics to look at in terms of valuation. But price book. Price book is always the good fallback if you've got an actual book value. So yeah. Yeah, the enterprise value to revenues is negative because of that figure as well. Funny. Guess we'll actually look at price to sales. Ugh, makes me feel gross to click on price to sales. How cheap they got down here, though. That's insane. The gaming crackdowns. Ah, that makes sense. That makes sense. I forgot about that, honestly.
Yeah, I mean, it was the COVID year, so obviously there's like a bazillion things that could explain that. I was just wondering what it was in particular because it seemed like maybe it was like a divestment or something, and so I kind of specifically was trying to figure out maybe if it was a divestment because that would have been more, you know, more reasonable, right? It would have been something that you can actually explain it away and say, oh well, it's not actually bad because this, you know, right? That's actually something that can be like more of an excuse for bad numbers. Excuse in like the good sense of the word. Look at their cash flow. Then Aryan wants me to take a look at Tesla. I'll take a look at Tesla. I haven't looked at them pretty much all year either. Well, we looked at them a little bit when ARK put out that one, their most recent estimates for that, but I can't remember what month that was anyway. So yeah, obviously pretty poor net income situation up until this kind of weird exception situation in 2021, which was what was happening there. Hold on. What flipped it? We have earnings of discontinued operations. So they did discontinue something here. So maybe there was a divestment. Maybe there was, because they could have been holding on to the discontinued operations. I don't know. It's possible that that discontinued operations happened in 21 though. So this thing is that could just be a total coincidence that they're talking about discontinued operations here. I don't know. Maybe I'll go read their report afterwards or something, try to figure out if that is an explanatory factor. Obviously, I mean, I've said before, I'm generally not super interested in Chinese stocks, but I'm trying to take a look at it at least a little bit. So yeah, coming back over to the cash flow though, see how that deals with things. And yeah, they readjust for that discontinued ops. So again, because it didn't actually affect the cash flows. So that's one thing you can often see here. It's like if you have like a weird, super big number in the net income thing, it won't be in the cash from operations thing, and you'll be able to see that difference because you'll have approximately the same number in the like other operating activities, although they could have also categorized it in both spots here, net from discontinued operations, and then it'll be similar number levels, but maybe not exactly in those. So you can kind of see like where the accounting switches things, which gets back to the cash flow video or live stream that we did the other week. I was talking about this where it's like they subtract things out in the net income statement, and then when they come over to the cash flow statement, they're adding things back on, and they often add things back that they already subtracted out from the previous statement. Like for example, depreciation and amortization, you subtract it out to get to net income, and then you add it back on in the cash flow statement because it was a non-cash charge. Sometimes that's the case with a discontinuing charge as well. Sometimes the discontinuing charge does include actual cash though, so it can be a mixture of things depending on what's going on. But anyway, yeah, so then the cash flow from operations will then basically be like that didn't happen. It'll be like as though that part didn't occur. Yeah, so then getting a big cash payout here as well in the investing activities, that's probably similarly related to how they're accounting for that. It's hard to say without knowing exactly what's going on there, but yeah, looks like, yeah, they're changing up their business in the last couple of years, so it's maybe more forgivable, some of the weirdness. It's possible that some of the weirdness is just them readjusting everything a bit more, but hard to say without looking at, like, you know, I don't know, active users and units and subscribers or whatever metrics they've got and stuff. You gotta kind of get into the KPIs a little bit. And then financing, issuing debt and paying down debt, repurchasing some stock a little bit. Interesting. So I mean, at first glance, it looks like a total basket case and it looks like total garbage. But if you look a little bit more closely, it looks like maybe more forgivable than otherwise. I will say that. Like I said, I'm still just not. I don't know. I just have such negative feelings towards investing in China in general. At least China, like I said, China inwardly focused Chinese companies. It's like more internationally focused Chinese companies I'm probably more interested in. But it's like I just feel like I have such limited ability to like actually understand like who's buying the products and stuff. So without like going onto their platforms themselves, like I don't use it, right? So it's one of those things where it's tricky to do. I mean, I had the same attitude about some European focused software companies too, where it's like, yep, this looks like it could be interesting, but if I'm not using it, it's hard to say. But yeah, I don't know. This one definitely, like I said, the numbers look kind of interesting. Because some of the, like I said, some of those things maybe are forgivable, but check the long-term chart. Is that it? They IPO'd in about 2018. I mean, they definitely been coming down like crazy. And obviously they had their moments in the sun too, where some people could get some massive payouts here. Yeah, well, this is this one. Well, this is on Ticker. So if I come over to TradingView, we might be able to get a there you go. There we go. Yeah, Ticker may not always have all the information super well. What's in here? Crazy. That's pretty crazy. I mean, I'd be curious to see what was happening here. And then also, I mean, this is share price, right? So like share price, if we also had market cap next to this, that might paint a different picture too, right? I don't know. We saw that over the last decade, they didn't do a whole bunch of share issuance, but it's possible that maybe they did so in the previous decade. So I don't know. And now it's priced to bankruptcy, but it can't go bankrupt. It can't go bankrupt, sort of. But I mean, you know, it can be requisitioned out of existence, but it's probably not likely to occur necessarily. No. Yeah, I mean, it's probably not necessarily that type of risk. It's just a question of whether or not you like the products and services and think it's going to grow. Yeah, but I don't know. It's like I said, it's definitely a curiosity. I'll give it that. All right, we'll take a look at Tesla, Arian. I'm gonna look at Tesla in a little while. Let's actually see what their financials have been like this last year. I haven't actually really been looking at the numbers, so I'm kind of curious what's it been looking like. We're up to 94 versus the 81.5 or so from last year. That's a significant slowdown right there. Am I going to look for jobs like in investment banking and big banks? Not necessarily. I mean, I'm applying to those places, but I don't I'm not necessarily super feeling pulled towards some of the more some of the larger institutions. But we'll see, you know. We'll see where we go with it. It partially comes down to just the type of competitiveness that some of those positions are in terms of like trying to go for them. I'm kind of trying to shoot honestly for smaller institutions a little bit more, because I think it's a little bit less competitive in terms of like the hiring process. So I don't know, that's kind of been my strategy in terms of a lot of the places I've been applying to, but I have been applying basically everywhere, but I've been putting more effort into different places. Last from Jackson, the Chinese companies trading deep under book value that are sketchy as fuck are not my thing. These companies with some established operations trading deep under book value are fascinating. Yeah, see, that's the thing. It's like there's gonna be a few of those actually pretty decent ones with similar pricing being traded very similarly with that whole other group. And you know, Chinese stocks just get this almost have like a reputation at this point for trading at that type of cheapness, because people literally don't believe the cash levels are even real in some of those companies. I mean, like I said, this particular company though, the type of not Tesla, but the type of industry that it was in is definitely not the type of industry where you see that like real questionability about those issues as much, because it's not like the type of industry that the state has as much incentive to care about. But at the same time, was it last? Use your screener, find the deepest value finance company, apply there, and show them your DCF. I mean, maybe, yeah. I think one or a couple of the companies that I'm currently a little bit more hopeful on trying to get a position in definitely has public stock, and I haven't gone around to looking at them, but I was on the website and was noticing that. So, I mean, and I'm curious to see, you know, like I said, I put my channel on my resume, so possible that if depending on what position I get and what company I work for, I might they might not want me doing a whole lot of public research on finance companies. I might end up having some limitations on the type of companies I can talk about, possibly, but we'll see. I don't know. Like I said, depends on the type of job I go for. This is the thing. I'm getting a finance degree, but that doesn't mean that you have to work for a finance company. It's like every company uses finance people, and then there's also like just off of not just like in terms of corporate finance, but there's just banking broadly. Like there's a lot of things you can do. So I'm trying to apply pretty widely, and I'm not really trying to be super committed to like one specific direction. So I'm just interested in getting out there and working, basically, and trying to show the most interest in the companies that are showing the most interest in me, frankly. Buy a position and show them you're committed. I mean, that's true. If they were smart, they would just sponsor it. And I watch a decent amount of finance YouTube, and I have heard of some cases of people doing that. I've heard of many different situations. I've heard of some YouTubers like literally having limits on the things that they can talk about and the companies that they can invest in, even though they're still doing it in the channel. But so obviously they weren't entirely banned from it. And then I've heard of other people who have basically gotten sort of collaborative work with their actual company. So I mean, I've heard of some cases of situations like that where they were more than just okay with it. They were actually like supportive of the idea. So that certainly is a potential thing. But like I said, it all depends on like what type of company and like what type of position it goes for. Because not all the types of positions I'm going for are necessarily about investing. I'm applying for banks, I'm applying for insurance companies, I'm applying for all sorts of stuff. I'm applying for manufacturing companies, right? So it's like I'm applying for all sorts of positions. So just also people need finance for everything. So anyway, let's keep going with Tesla. See, return on assets, it looks like in the trailing 12 months has come back down a little bit, which compared to the kind of never-ending increase, that's kind of interesting to see that. Well, let's pull back further, because obviously we had a little bit of more playing with our heart back here, but for at least for the last 5 years, it's been a continual upward movement on the return on assets up until the last trailing 12 months. Maybe the last quarter, they'll manage to outperform and bring it back up over 12% or something like that, but it definitely is a little bit of a dip down. I would 100% go for a job in investing. You're obviously more passionate on that. No, I am more passionate on that, but like I said, it all kind of depends on like what I'm doing. Like it's almost one of those things where on one hand you do want a job you're passionate about, but on the other hand you don't want to end up doing a thing that you're not that interested in related to something you're passionate about, because I don't want to ruin my passion at the same time. And that's kind of like the way I think about it. It's like I do all this stuff on the side already, so it's like if I'm not specifically focused on like equity markets in my job, that's okay, because I can do it at home. I just want to use finance. Like finance is finance. You're using present value and future value, and making capital budgeting assessments and stuff like that. Like at the end of the day, you're basically always doing that one or both of those types of things in there somewhere in some form. Market research, yeah, I mean, I would like to do market research, and then I also have ambitions for things that I could do and develop myself. Like I bring that up because you bring up market research, but like I like very seriously might put together like my own consulting firm or something like that. Like that's something that I have like a personal maybe ambition for doing myself. So that's the thing, is like I don't necessarily need my most immediate career out of college to be specifically focused on something like that. There's like a lot of ways I can kind of get around to doing the things that I want to do and the things I'm passionate about. I want experience. That's kind of like my attitude with this, where I'm like, oh, I don't really care what I do. Like it might sound like I don't care. I do care. It's just that I'm kind of just trying to get out there and get experience. I'm not really like super hung up on the immediate door that I walk through, is the kind of the way I'm looking at it. M&A at the Big Four. I mean, like I said, I'm applying to the Big Four. I just am not necessarily super hopeful for the Big Four. And it comes down partially, somewhat, I will say it's somewhat about my age a little bit in terms of like the specific positions I'm applying for, because like I have to wait to like right now, for example, they're doing most of the internship positions, but with the way the internships are set up in terms of like for the school years and stuff like that, I'm a senior that's going to be graduating into next year, and so a lot of the current positions that are literally out like right now are for internships for people who are going to be returning students in the fall of next year, which is not me. So like, for example, there's like actually like a bunch of companies that I can't even apply to literally right now, and I have to wait till like spring to start applying for. And then there's a large such kind of companies that like, to be honest, like the type of work that they're specifically going to be looking for isn't necessarily the type of work that I want to do. Like for example, like I'm not looking to go to one of the companies where they have like really would you work at Deloitte? Well, I mean, I would work at Deloitte, but the point is I'm not necessarily pushing super hard to try to get to one of the big four type companies. It partially comes down to work-life balance. Like I am finishing my degree next summer, but at the same time, I'm also not a 22, 23-year-old. I'm a 31-year-old. And so I have a little bit of a different balance in mind. I'm not trying to go to one of the places that like is going to demand 80-hour work weeks from me. Which might seem like a strange choice, but that's my personal choice on that. It's like I want to go to work, but I also don't want to necessarily go somewhere that is only trying to push me in to a specific work-life balance. It kind of comes down to the specific situation, but like there's I'm not necessarily looking to go into the most competitive of career paths in finance. Partially just because of that's just where I am in my work-life balance. Yeah, no, that's what I'm saying. It's like it's like I would be interested in a job at the big four if I felt like I had a pretty solid in on it, but at the same time it's like it all depends. I don't know. I'm not saying I wouldn't do 80-hour work weeks, but the point is I would be trying to only do that for a very short period of time and then sort of get away from it at the same time. It's like I wouldn't be the type of person that's like gonna want to do that for my whole career or whatever. It's like I would maybe want to do that for a year or two and then kind of work my way out of it. And I know like the general kind of like career path that they work you towards at a lot of those companies. I'm like I said, it's just I'm not sure that it's exactly the path that I want in my situation. But do it at 40 hours, then bill it for 80. Well, maybe, but point is yeah, maybe you have to have a certain amount of position within the company to be able to do that. I don't know. I don't know how it all works, but I'm literally some of the positions I'm specifically shooting for right now that I'm very hopeful for are like some management track positions at some banking institutions, some analyst positions at insurance companies. So like those are some specific positions that like I'm currently like in the interview rounds for that I'm like somewhat more hopeful for. And they're not like super huge institutions. They're relatively smaller insurance and bank institutions, but what they do have is they have I think more positions opening up into the higher level paths at some of those tracks. Like, cause like I said, like there's a bank that I'm currently applying for that like they're trying to really fast track some managers because I feel like because of their size, they probably have some difficulty actually attracting certain people to stay there for longer. They probably have like interns that show up there for the internship, but then maybe don't want to get their final position there. Maybe they are trying to shoot for one of the more ambitious positions. So it's like I kind of feel like depending on if you maybe go for some of the smaller institutions, I feel like you can maybe fast track yourself upward a little bit faster. Maybe I'm wrong on that, but that's kind of like the way I'm feeling about it. So it's like I actually am kind of okay with going for maybe some smaller institutions because it might get me to some higher level positions maybe a little bit quicker. And you could maybe make the argument for the other way because the bigger like the big four and all that, you're going to have much bigger networking opportunities as a result of that. Plus obviously it's going to look super amazing on your resume. So obviously there's multiple ways you can look at it, but like I said, it's a balance between all the things that I've said. So Fidelity subbed. Yeah, I mean, like, I bring up my YouTube pretty much in every interview I can. If it comes up, I'm not trying to just bring it up randomly or whatever. Dizzy asks some question: who are the big four? When people say the big four, or I say the big four, we're talking about the four largest accounting firms in the United States, which make up the vast majority of the accounting work for like all of the Fortune 500 companies and all that. It's primarily for really large accounting firms that people talk about. Deloitte and Touche, like he was just mentioning the company Deloitte and Touche being one of the companies, KPMG, the other two don't necessarily come to mind super quickly, but you know, there's four major accounting firms that people often talk about, that they refer to them as the Big Four. We were going to talk about Tesla there, and then we kept talking about my education, but that's cool too. I kind of like how much we end up talking about that on a lot of these streams. But like I said, we have a few of the viewers who are current students or prospective students themselves, so they often have their own questions about it a little bit. And then, well, Jack's not a student, but he's interested in that. And hey, man, I mean, you could always send. You have my permission to send your own recommendation of me however you would like. You know, I would never say no to that. You know, by all means, if any of my viewers wanna really help me get a job, that would be super amazing. That would be super amazing. Definitely not gonna turn it down. Like I said, I would still maybe go for a job at Deloitte. It's just partially that I look at it as an uphill battle. It's one of these things where I'm looking at the cost benefit analysis where I'm like, I see what they would want from me. I think about how likely it is that they would necessarily pick me over the thousands of other applications that they're likely to get. And then I think about, you know, the cost benefit analysis there. And I'm just like, it's actually not my feeling that great of a cost benefit analysis. But if somebody can make it a much easier pathway to help me get to one of those jobs, that changes the cost benefit analysis, you know? So that's the thing, is like, what my comments are kind of based off of my default position. People trying to help and give recommendations can change things from certain perspectives. But anyway, though, I think that is pretty much gonna do it for today. We are getting close to that hour-and-a-half point. I super appreciate everybody who was here and commenting, giving suggestions, in the chit chat about school. It's always nice and interesting and stuff. I would ask, as people are walking out the door, whether you're watching live or on the replay, please like the video. Please subscribe to the channel if you're not already. Ring that notification bell if you haven't already. Check out that live stream that I was talking about from Stone Cold Investors that I went on this last week. It was pretty good. Check that out if you haven't seen that already. And then, like I said, I'm planning to put out a video on annual reports, 10K filings, and the types of information that you can find in them that are useful for valuations this week. In lieu of a DCF video, we're putting out kind of a learning to invest type video this week. But you guys can expect that on Friday. I'll catch you all in the next valuation video. Bye.